afternoon, well, good morning. It's still morning. Thank you all, and a special thanks to the Capital Link team and to all of our panel here, which has a great title, Investing in Shipping. And so what we're trying to do here is to get a sense of what investing in shipping is like today, what the environment is, what investors and Wall Street analysts see as the opportunities for investment in shipping companies, and how that coordinates with obviously with the capital markets serving the industry. We've heard a lot in the last couple of panels about the energy transition and where that funding may be coming from. And it seems like the consensus is that both consumers and capital markets will provide a primary source of funding for the upcoming energy transition and what we're undergoing currently. And as you've already heard, there is and will continue to be a very big number in terms of overall capital expenditure planned on an industry-wide basis and on the horizon, and particularly in light of geopolitical events and other events that are delaying, diving head first into that energy transition. So it's no secret here today that we must consider the uncertainties and the volatility in the markets stemming from macroeconomic factors such as inflation, the specter of a global recession, which has been, kind of back on people's lips again, interest rate hikes, which we heard a little bit about at the end of the last panel, the evolving situation in Ukraine, and more recently, stresses in the banking sector. So I'd like to welcome and introduce our panel. It's a lot to chew on, obviously. First, immediately to my right, representing Citi, Christa Volpicelli, who is Managing Director and Head of Investment Banking at Citi, and a special thanks to Christa and her team for hosting this great event with the Capital Link team as well. I guess next to Christa is Espen Lysdahl, Director and Co-Head of Shipping Investment Banking at Clarksons Securities. Immediately to his right, with the investor perspective, I would imagine, is Synvis, who is the Head of Fund Management and Portfolio Manager at Cleaves Securities. And of course, at the end of the row there, last but not least, Larry Glassberg, who you all know, Executive Managing Director and Co-Head of Investment Banking at Maxim Group. All right, well, thanks for all coming, and I think we should get started with some opening thoughts from each of our panelists. Let's start with Christa, who's immediately to my right. Christa, what do you see as the main theme for investing in shipping today? Is it the energy transition story, or maybe people are looking at more traditional metrics? And what are investors looking to capture through all of this?
Sorry about that. I would say it's two things, and it probably depends a little bit on the type of investor that you're speaking with. But one of the main themes today is cash flow. Most investors are here to ultimately make money, and there are many sectors of shipping right now which are doing quite well, especially compared to historical times. And so you have companies that are making significant amounts of money and are thinking about different ways to deploy that capital. Many companies out there have dividend policies which should greatly reward shareholders over the near term, but they're also thinking about dividend policies in a way that is preserving their balance sheet and their liquidity to be able to invest and grow for the long term, which is pretty exciting, and ultimately what equity investing is all about. With respect to energy transition and zero carbon emissions, I definitely think that is an important theme across both equity and debt investing. As we all know, there's no one solution for the global shipping sector today. It's a work in progress. But I do think that it is an important theme in terms of how management teams are regarded, and what kinds of things they're doing to be forward-leaning as part of that. But that can be quite intangible today, just given where we are in the state of development.
Thanks, Christa. Larry, What are you thinking about that with your shipping-focused, business over at Maxim?
The markets, clearly today are extremely choppy. And, I would tell you is our firm view 6 months to 12 months ago within the maritime industry is very different than where it is today. What we're seeing from a market point of view as it relates to maritime companies, I do agree with my colleague over here that cash flow is really driving a lot of demand into the market. I think ultimately, depending on which sector and which vertical you're in, there's obviously very different macro themes that are going in each one of those markets. But I think ultimately for us, our investors are driving to more cash flow. They're looking for growth and growth that you can get, very quickly. And I think a lot of that, especially if you're in the public markets, is the navigating of where your stock price is and where your NAV is, if that, even to a real extent is the right methodology or metric to be looking at from a capital raising point of view. But we've had companies over the last 6 to 9 months, even in challenging markets, go out and raise a fair amount of equity to grow their fleets, and they're now being rewarded today because of a significant amount of cash flow that they're generating. And if stock prices have come in during that time period, they're also, in some cases, buying back stock at very cheap levels. So depending on where we are in the markets, it is going to be choppy in the next, let's call it 6 to 9 months. But again, cash flow is king in these type of markets.
Thanks, Larry. Let me ask the same question to Espen. What do you see as, what investors are looking for and what you're seeing from your seat?
Yeah, sure. I think, to answer that question, it's important to also look at who the investor base is and who are, the active participants in this cycle. I think you need to sort of take a step back and address that first. And I think last year we saw not a great amount of deal activity, but we had close to 1 billion in primaries placed, a little less, and we were quite active as Clarksons in those transactions. And one of the things we saw was, number one, the geographical split between the investor base. It's more skewed towards Scandinavia and towards the UK than it was in the past cycle, where American investors were more active. So that's the first part. The second part is, the type of capital. The type of capital now is more trade-oriented, more hedge fund dominated than before. And as a result, that sort of sets the criteria for what the investors want. So we sort of see 3 key themes that investors are very focused on now. It's liquidity, it's a capital allocation policy, and more specifically dividends, and it's governance. And I think, we've placed transactions in pretty much all segments over the last 12 to 15 months. And they've been priced fairly similar, even though, we've done transactions for product tanker names, and we've done major sell downs for container names. And we're seeing sort of the same trend. Investors are looking at those 3 factors, not exclusively, but as at least it's very important ingredients. And then I think the second part that makes this very exciting is, of course, the fundamentals, which we'll get into a little later.
Thanks very much. Carl, from the investor's perspective, I know that in our firm, and I can see where the focus is, we have a worldwide practice, and it seems that anything that really touches more of the future of energy seems to be of interest to a lot of folks. Just wondering from your perspective, how does shipping fit into the overall picture in your funds management practice?
Yeah, thanks. So I'm a bit on the other side of the table because we are a small company, shipping-based company from Oslo, and we started a hedge fund last year, in July last year. And I believe that the interest in shipping as in general is increasing rather rapidly. And we have seen interest from all over Europe, actually, and we have investors, of course, from all over the world. And I think I agree with Espen, but I also think that many investors, they want to take part in the recovery of the China story, so they want to be in shipping to get the performance out of the recovery in China. And yeah, it's a quite special situation with the fleet growth situation, and I feel that over the last 2-3 months, investors are focusing more on the shipping sector in general, and they want to invest and be a part of the shipping. I also think that we are in the start of a pretty good cycle in shipping, and yeah, it's exciting.
Just to drill down a little on that, do you see any sector-specific issues that you're thinking about in your business? And also, I noticed that Espen had discussed a little bit about governance. So how does that fit into your picture when you're looking at portfolio investments in the fund?
Yeah, so I think from my point of view, it's very important to have shipping as a part of a portfolio. Our fund is close to zero correlated to the S&P. But I think most of the interest sector-wise is in the tanker market and of course the bulking sector. So I think going forward, it will be most interest from our investors will be in those two sectors.
Thanks very much. Let me just switch gears a little bit. So turning a little bit more to recent events and some of the more political issues and how that might intersect with investing in shipping and capital markets. With recent events, such as Russia's apparent escalation of its attacks in Ukraine, and the news about the bank failures here in the United States, which of course was somewhat unexpected and made a great impact here. What is the general state of the capital markets, both public and also in the side-by-side in the larger private, I guess, capital markets rather than the public markets? And let me start with Christa on that question.
Sure. Well, I guess I would start by saying if you would have asked me that question maybe 1 to 2 weeks ago, I would have said that the capital markets feel that they've been starting to function more normally as people started to get some consensus around the trajectory of when interest rates will peak, some consensus around just overall recession, soft landing, all of those kinds of questions. Obviously, over the past couple of weeks with the topics that you just mentioned, there is questions and concerns, although with some of the actions that have been taken with government stepping in, with other banks stepping in, either to inject capital, as Citi and some others have done, or the potential takeover. Actually, markets are up today in terms of investors feeling like there is some level of support, and the knowledge that there is, with respect to the larger banks, a degree of health overall in the system. So I think there's hopefulness that this can stay contained. Obviously, there's still risks to that. And geopolitical, it's anyone's guess in terms of what will happen and when. But certainly, I think that's why, if you look at what most public companies have been doing, there's been a high degree of focus over the last 12 months of just making sure that balance sheets are strong. And we've been in this scenario where there's certain sectors that companies are making a lot of money and they are rewarding shareholders, but they're doing it in a way that's different than 10 years ago, where we had a lot of high payout companies that were not sustainable. I think the thought process amongst many management teams is different today, and so that will be helpful to deal with whatever there is to come in terms of the outcome of some of these events.
Let me just go across the table to Larry. When you're sitting in the room with management teams in the shipping industry, how are they reacting to these recent events? And is it affecting, like we said, maybe in their use of their balance sheet, the type of transactions that they may be looking to you to help them bring to the market?
Yeah, listen, I think every single situation is going to be different than a management team or company is going through as they're navigating through, very challenging times. I do agree with Christa. If I look back 2 weeks ago, very different market than we were in the last 2 weeks. In the last 2 weeks, I would say it's probably been one of the more challenging times that I've seen in the last 7 to 10 years. And I think it's more geopolitical and things that are driving to people not necessarily knowing where the bottom is yet. So as any company, and fortunately for where I sit, I'm not only looking at Maritime, but as a group head, I'm looking at many different sectors and many different verticals. A lot of the Maritime companies that we're dealing with today are generating cash flow, and there isn't a gun to their head to come into the market necessarily to go raise capital. I've always preached is that you have to be opportunistic in many situations, and if there is the opportunity to go out and raise capital outside of whatever your budgeting and long-term goals are, you want to take advantage of that. Because even in a situation where the market potentially comes in, if you're in a stronger balance sheet position, that's going to create other opportunities for you in the market. From a general Maritime point of view, we've probably done 3 or 4 transactions already this year. And each week to 2 weeks we've been in the market with deals, the market has been so vastly different from week to week. And I think that's a lot of the function of the volatility that's in the market today. So the market's going to remain volatile. Management teams of Maritime businesses, like any other business, have to be prepared to be able to go when there's an opportunity that allows them. Clearly, that's going to be very different in the public markets versus the private markets. But cash flow is king, and I think you've heard the panel say 5 or 10 times already. Having cash flow and generating cash flow is going to give you more optionality within the market.
Espen, let me turn to you. Thanks, Larry. Espen, let me turn to you on that same topic. You seem to have and your organization has a greater focus on the Norwegian bond market than some of the perhaps others sitting at the table. And just same question to you is, do you see that dynamic changing a little bit? The Norwegian bond market has been extremely active year to date. And do you see these recent events in the last week or two as changing that dynamic?
Yeah, I mean, obviously, generally speaking, the market right now is very turbulent. But I think, looking back at the last 12 to 18 months, we've had very good inflow of capital to our sectors. We've had lots of transactions, not in terms of volumes, historically speaking, because they typically correlate highly with order books, which we saw at the panel earlier today are at all-time low. But I think one of the sort of differences on I would say that the Norwegian stock exchanges and the capital markets in Norway as opposed to the US market is that it's facilitated in a way where it's more tailored for the maritime industry to actually respond and get transactions done when the opportunity arises. I think, as an example, if you're a new company and you're seeking to list, you have an opportunity that you want to take advantage of by utilizing the capital markets in Oslo. You can do so on fairly light documentation in a short amount of time. We're talking weeks and not months. With an intention and a promise to the investors that you will do the documents, the process of listing afterwards. So that has sort of become the more trodden path in Norwegian capital markets, at least for new entrants. Which is also probably why we saw at least some of the follow-on activity that occurred last year. Coming from Norwegian issuers as opposed to US issuers. When it comes to the bond market, I think it's interesting to hear all these other panels on what seems to be a common consensus here on a focus on deleveraging and having more robust and resilient balance sheet with lower break-evens and focusing on dividends as opposed to increasing leverage. And I think, that obviously corresponds with the order book and opportunities, limited acquisition opportunities and growth opportunities. But for some issuers that are frequent issuers in the Norwegian high yield market, they've managed to tap into that market very efficiently now. And as both Christa and Larry said earlier, there's been good inflow into our markets prior to this bank crisis, and that has also we've also seen new issuance in particularly the Norwegian bond market as a result of that, and also very much so in the offshore sector.
Thanks, Espen. Carl, I thought maybe you might have some thoughts on that general topic as well. And I do note that at least here in the U.S., I've been hearing anecdotally that there's been quite a bit of activity among investors in the funds, asking for redemptions in light of the more recent activity. I'm not sure that's still ongoing, but that seemed to be a topic in the media here last week. I was wondering if you had a point of view on that from the Norwegian perspective primarily. And also, do you see yourselves at Cleaves as having kind of an open lane now in this industry?
Well, we haven't received any redemptions yet, so that's good. But I think, the last couple of weeks have been volatile, and it's difficult to see the end of it. But I think for the shipping space and the companies that we in the fund are invested in, I'm not that worried about the bank crisis isolated for that company. So I think most investors now will use this opportunity to invest, and as by now I haven't seen that kind of redemptions or investors that are really concerned and stuff like that. So from my point of view, I think this will end pretty good, and in case of shipping, I think it perhaps may be a good opportunity going forward to buy some shipping companies that are cheaper now than 2 weeks back. So
Well, I think that's a theme, right? Buy low, sell high. So looking for the cheap companies, why not? The next question really is more for the investment bankers. There seems, at least in my mind, there seems to have been, at least in the past several months, not as much interest in new issues and U.S. capital markets in terms of capital raising, as I think had been expected if we were going backwards. I think we had indicated in the last couple of panels, going back to the third quarter of last year, and as late as last month in Athens when we met, the spark in capital markets activity, I'm not sure has been as robust as we had expected. And we see that Danaus recently filed a universal shelf registration statement. Himalaya Shipping, a dry bulk company currently trading in Norway, did an initial filing for an IPO that would be led by DNB and Clarksons. And earlier this year, Ocean Pal, the dry bulk spinoff of Diana Shipping, closed a deal for units and warrants that was led by Larry's firm Maxim. And I'm just wondering, what do you see as the prospects for both IPO and follow-on capital markets equities in the U.S. markets? And let me throw that over to Larry first.
I would say it depends on where we are, from a market cycle, like we've been talking about, today. One of the challenges, obviously, if you're going to do a deal in the public market, especially from an IPO point of view, is you're very much subject to what the broader market is doing outside of just what your sector is doing. Generally speaking, the IPO market has been more or less shut this year. There's been a handful of deals. We actually did a very small IPO in the last week or so that fortunately has traded up. But finding demand for new paper coming in from an IPO point of view, I think in this market today is very challenging. Now, will they get progressively better as the market, firms up? Generally speaking, when you see IPOs getting done, you're in a very strong market and you have the ability to drive a lot of demand into issues in a stronger market. In a softer market like we're in today, new issues are very difficult to get out because the valuation arbitrage usually is not there, because a lot of companies might be trading at significant discounts to whatever their intrinsic value is. The secondary market is very much going to be driven by companies that need to raise capital or opportunistically want to go out and raise capital if there's something that happens in their stock price. Remember, public companies, as you're out there, especially if you have a liquid security, they could take the life of their own. Sometimes they trade rationally, sometimes they don't trade rationally. And a lot of times when you see issuers raising capital is when their stock is not trading rationally, and maybe they get ahead of themselves, they give the opportunity to go and sell equity in those markets. So we've seen it across the board from issuers that we work with. A lot of the issuers that we may work with might be very different than, say, a Citibank, where the size of that market cap is vastly different, say, to a sub-$100 million market cap to a multi-billion-dollar market cap. And each one of these companies, depending on the size profile, is vastly different from what they're looking at doing. It's like, I always make the scenario, it's like a doctor that's a brain surgeon comparing it to a foot surgeon. You kind of know what the system in the body works like, but what you're doing specifically is vastly different on a day-to-day basis. So generally speaking, the issuers that we work with, we always have them prepared to go, and we opportunistically get into the market for secondaries when we see there's a window, not only from a valuation point of view, but also from a liquidity profile point of view.
Yeah, Christa, I'm sure you have some additional thoughts that you could share with
So
us.
I'm not going to ask Larry who he thinks is the brain surgeon and who he thinks is the foot doctor, but that was an interesting analogy. So I think those are all good points made. I think the one other element I would add to this maybe goes back to another discussion we were having about, Norway markets, U.S. markets. I think that increasingly investors are sophisticated enough and willing to look globally across different exchanges. And so we actually find, as we're talking to issuers, the decision of, are you listing in the US, are you listing in Norway? Really there's a lot of elements to that decision in terms of market depth, trading liquidity. When you think about, is there a valuation arbitrage, that has kind of started to close. I think people will look across different exchanges. And so, sure, there's different document formats you can go faster, but there's some investors who aren't going to accept that kind of situation. So it's a question of company size, what a company is trying to achieve in terms of access to capital today, as well as access to capital and trading liquidity over the longer term. And so I don't think there's one right answer. It really depends on the company situation. And I think, Larry's comments are, you can do big or small in the US, but, the kinds of investors that you attract will be different depending on the dynamics of the company.
Well, that's an interesting statement. So it's always been, my understanding, and I think the general notion, that the large amount of capital that's necessary in certain industries like shipping, like aircraft financing, for example, that the U.S. capital markets was the primary source just due to its vast size and ability to absorb larger deals in a more diversified way, as opposed to maybe something like the Norwegian market, where at certain times the shipping portfolio in Norway was a much bigger percentage of the overall Norwegian capital markets. Are you seeing, let's talk about who the investors are then. If the investors are more fund-based as they are, and I guess depending on what kinds of funds they are, and larger institutional investors, do you think that they'll be more agnostic as time rolls on to investing in some of the regional markets? Or do you feel that they still feel that the U.S. capital markets gives them the greatest opportunities for diversification?
I think it depends on the investor type, because there's going to be some funds which are smaller who will have a regional focus, and that's where they will focus. I think the larger global funds are the ones that can look across markets, and so, are happy to invest in a company, whether it's US listed, Norway listed, et cetera. I do think it is still a statement that to be made that the larger the company, the greater the need for liquidity. The US is probably the right place for it. But, Citi is active in Norway as well. We've got a local institutional sales force there. We have a different offering than, some of the banks here, and so that's just a function of who we are. But I do think that it's really the larger global funds that are the ones that will cross those markets.
Thanks, Christa. That's actually very interesting. Espen, let me turn to you for a second, and we're going to just move on a little bit to something that the last panel touched on, which is offshore wind and infrastructure projects that are going on around the world. Of course, these projects require shipping assets in order for them to, really get done. And I think we're all interested in where that financing will continue to come from as it grows, how investors can participate in that. And I noticed, there's been some financing activity in the Norwegian market, such as this so-called super senior bonds that were issued by Flotel International, which is kind of an interesting thing. And that was banked obviously by DNB and Pareto at I think a pretty substantial coupon. How do you see that unfolding, and what do you see for the opportunities for shipping assets in the wind projects? Is that a separate lane, or is it just part of the overall energy story?
Complex question. I think it's a little bit outside my scope, but I'll try to answer. I think if you look fundamentally on the offshore wind sector, there is obviously a lack of new orders coming in that can absorb the demand or expected demand, and as a result, you are sort of relying on not rebuilding, but you're essentially upgrading offshore assets to accommodate the type of work that is needed for that industry. So we have seen some activity within that space, but I think what's interesting is that there are two markets that are firing on all cylinders simultaneously, and then you get obviously a very tight market. In terms of financing, I think, and for capital markets activity, offshore isolated is an industry that's much more dependent on that than offshore wind. And they don't have the same access to bank financing. They are also relying on the capital markets to function in order to take advantage of the opportunities that they see in the market. But it's so that in itself is quite interesting. But I think two things that I want to clarify. I think one important feature about the Norwegian high yield market, which is a little bit different than the U.S. high yield market, is that the majority of issuance is actually done on floating coupons. So that means that you have a bit of a different exposure throughout the cycle and throughout this environment that we're seeing right now, which is also why a lot of the secondary market pricing of those instruments have held up significantly better than it has in the U.S. markets. So that's one difference, and I think we'll see more issues, of course, but it's also very difficult to. So you mentioned a coupon of 11.25%. I mean, it's expensive. Let's face it, it is expensive, and it's expensive a layer of capital in the capital structure, and it's also for more commodity shipping companies that are focusing on the leveraging. The unsecured bond market, both in the U.S. and in Norway, has been a typical instrument to utilize and sort of tap into the equity component of your capital structure. That is, of course, less relevant now with tanker and bulker names having a net LTV between 20 and 30 and 40%. So I think we need to see ordering in order to actually get that market to fire on all cylinders for our sectors, but there are some frequent issuers that will remain in the market.
Carl, I'm interested in what you think we're seeing in and around wind project-related shipping assets.
Yeah, well, so our fund is a shipping fund only, so we are not investing in the wind or offshore or anything like that. So yeah, it's a little bit outside my field of expertise, but I know that within the Cleaves system, we are actually planning on starting something up within the sector, so that's exciting. But yeah, it's nothing relevant for our fund.
Okay, well, we don't have a lot of time left, but maybe I can go up the row here and have each of our panelists give some final thoughts on investing in shipping, capital markets, and kind of just open up the table and the dialogue to maybe some structures and themes that you might feel it's important for the audience here to start to consider as we move into the next phase of both the energy transition and also what we're seeing as kind of a new dynamic in shipping and financing and the relationship between banks, capital markets, and also alternative investors. So we'll just maybe start with Larry on the end there and see what you think about that.
Yeah, listen, I think as I've already said, and I think a lot of our panelists have already said, the markets are extremely volatile today. In terms of sector focus from our point of view is, we're agnostic as it relates to which vertical we're going into in the maritime space. What we're ideally looking for is very strong management teams, the ability to scale pretty quickly, and navigating the market at different times. I think, we are seeing, the ESG component come up into a lot of our deals, whether that's 100% relevant for shipping or not, tough ESG stories in a lot of regards. But there are opportunities within that value chain that we're seeing out there today. Generally speaking, from a growth point of view, the U.S. capital markets for maritime companies is a incredible facilitator for capital raising. You just have to find the right opportunities in the market life cycle. IPOs in this market, like I mentioned before, are going to be very challenging. I think you will see people opportunistically do things in the market, in particular around reverse mergers, utilizing SPACs, not necessarily to have cash there on the balance sheet at closing, but as a mechanism to get public. And a lot of companies are utilizing that as a methodology to then scale post-closing of those transactions.
Thanks, Larry. Christa, perhaps you have some final thoughts on this intersection of different funding sources, investing in shipping, et cetera.
Sure. I would say it's an exciting time to be looking at the sector as an external investor. There's lots of great opportunities and management teams out there. I think that there's lots that you can find and study about the different dynamics, the order book, the demand, et cetera, and so you can figure that out pretty quickly. But I think what's most important today is the credibility of management teams, their commitment to corporate governance, their commitment to how they're navigating through the energy transition, both near term, medium term, and long term. And ultimately, it's about building a business with a strong balance sheet, financial flexibility that will earn investors money today and be able to grow in the future. So you really have to dig into individual companies to figure that out. Gone are the days where you could just look at dividend yield and think that that's a comparison, because there's so many different policies out there. But depending on what your flavor is, there's lots of opportunities.
Thanks, Christa. Espen, if you have a couple of short words, we're pretty much at the end here. So.
Though just fundamentally speaking, I think we're heading into what looks to be a super cycle for certain segments in shipping. I'm extremely excited myself. I think there will be a lot of opportunities ahead. We have an order book for the dry bulk fleet of 7%. The same number is 5% for crude and 4% for product. If you look at just VLCCs, that order book is now at 1.6%. There's 15 VLCCs at order. And we have rates above $100,000 a day. So I think we have I think we have some really exciting times ahead, and if you're an investor that is considering to start spending more time on this sector, I would encourage you to do so.
Thank you, Espen. Carl, maybe you have a couple of quick thoughts before our time expires here.
Yeah, so Espen said everything I wanted to say, so thanks. But,
You're welcome.
No, I agree. I'm extremely positive going forward, and yeah, as everyone has said, we have the both supply side and the demand side, especially for the tanker sector and the bulker sector, looks extremely good. We have the China recovery. We have the extended ton mile because of the situation in Ukraine. So I think everything put together looks really, really good. And yeah.
Thank you very much.
Yeah.
Thanks very much. Unfortunately, we're out of time. But I'd like to again thank the Capital Link team and the Citi team for hosting us today. Great panel, and thanks again. Thank you very much.